Yeah.
Yes, sir, we can hear you.
Yes, if you want to say something, your friends or online, stuff like this, they cannot hear you. You can just start one by one. Those who are online, your friends, those who are sitting in the classroom would like to say something to you. Yeah? Who's that? Madam? You don't have any love of fellow beings? At least, hi. Yeah. Hello. Come to classes. Yeah, in class only, no? Friends, those who are online would like to say something to these people who are offline now. Communication. They don't want to communicate. They are hearing or not? Yeah, they are able to hear. Once again, can you confirm those who are online that you are able to hear us?
We can hear you, sir. Yeah. We can't see you guys. Yeah.
Oh, is it?
Yeah.
Okay. Fine. Classes you can come to the class. Right. They'll come to the class when there is an exam. Some difficulty they are online. Okay. Fine, no problem. Anything you'd like to ask on the previous sessions? Those are offline, offline. Equity ratio. What is that? Oh. You want to reiterate on ratios? The last class we have discussed about the financial statement analysis, right? One of the powerful tools is ratio analysis. In the ratio analysis, we have discussed so many varieties of ratios. Normally, 4 groups of ratios we discussed. Performance ratios, solvency ratios, liquidity ratios, and liquidity ratios, solvency ratios, activity ratios, then profitability ratio. Okay, solvency, liquidity, activity, and profitability. These 4 varieties of ratios, these 4 group of ratios we discussed. Among these 4 groups, we have individual ratios as well. We have list of ratios under each category. So, for example, profitability ratio, the group of ratios. We have gross profit ratio, net profit ratio, operating ratio, operating profit ratio, expense ratios, etc. We are under a group called profitability ratio. Similarly, we have so many other ratios under each and every group. So what exactly you want to know? In that, one of your classmates in the class is asking something on ratios. Yes, sir. What is that? Yeah. Which one you don't understand? Ratio itself is not understandable. Debt equity ratio. Debt equity ratio, anybody? What is the meaning of debt equity ratio? Normally, ratio means a mathematical expression of the relationship between 2 variables, related variables. Now, 2 related variables in each case is debt and equity, debt equity ratio. Debt means what in general? Debt refers to outside liability can become as debt. Equity. The owner's claim in the business is called equity. It's the relationship between the owner's claim and outsider's claim in the total assets of the company. Suppose the total assets of the company is 1 crore. How much is made out of owner's fund and how much is made out of borrowed fund, outsider's fund? That relationship is being captured in a ratio. That ratio is called debt equity ratio. What's the formula for debt equity ratio? Total debts divided by
shareholders equity.
What's the date of the formula fully?
Total outside liability by
Total outsiders liability divided by
shareholders.
shareholders equity. Out of 1 rupee, how much amount is raised from outsider? How much amount is given by the owner to create the asset? Okay, suppose numerator, the total debt is equal to 2 rupees and the owner's equity is 1 rupee. But the ratio now 2 times of 2 times of
2 times of the
borrower capital and 1 time of the owner's capital. So total asset will be 3 times. 3 times of owner's capital. If 3 rupees is the asset, total asset of the company, 2 rupees is borrowed. 1 rupee is 1 rupee. So this is the relationship between owner's fund and the.
No, but it should be 1:2 or there is nothing like that.
We already done now, but they normal standard equation for the equity.
Shareholders equity by net assets.
No, I'm asking what is the number, standard number for the equity.
Normally it should be shareholders should be more than the borrowed. It is
Okay, in last class we discussed it now. Did you written anything on? Have you written anything on? What is the standard ratio?
We wrote on current ratio, which is 2:1.
Everyone? Yeah, in
net equity.
good ligate. Talk about good ligate.
So it is 1:1.
1 is the
1:2.
standard ratio
That
is
means 2 rupees should be owners and 1 rupee should be borrowed.
2 rupees should be the 2 rupee can be the borrowed money for 1 rupee of owned money. Normally owned money should be less. Huh? So what the equation? Read the equation. The equation is equal to what the equation? What is that?
Total outsiders there from this divided by shareholders.
Okay, suppose total outside liability is 2 crore. Shareholder fund is 1 crore. What is the ratio now? 2 by 1. How do you express that? 2:1. 2 times of outside liability is expressed by 1 represented by 1 times of internal liability. 2:1. Now tell me the standard ratio. What is the standard ratio given in the 1:2? 1 time of
Debts. Outsiders.
outside liability can be represented by 2 times of. If that is the case, more safe you are. More safe. I told you a lot of examples of it. We have to take this. So I contribute 2 rupee. I borrow only 1 rupee. You are very traditional. You are safe. The loan given to the company is safe. If you are going to give loan to the company, you are safer because the company's loan is very, very less. If any shock is there in the future, the shock can be absorbed by the equity holders easily. That's mean. That's why it's more safer. But normally, you will take this. What is paying you risk? What risk is here? Financial risk. You are encouraged to borrow more money to do business and get more return, pay some small amount or fixed amount to the loan holders, and you can give all the money to the shareholders. So that shareholder value will increase. Okay, it's 2 sides. You have to look from whose side it is. Equity shareholder point of view, equity can be less, borrowed money can be more, so that they can get more return on equity. From the lender side, from the lender, who will lend you money when they feel safe by lending your company, they will give money to you. Otherwise, they won't give. So they will be thinking that less borrowing should be there in the company, so that I can give some more additional lending. So my money is safe. You have to read all the equations. You have to read just based on the framework equations formula. Anything else apart from this equity? I share the file with in the LMS statement. all the formulas and equations. Okay, today what we are going to do, before we start this cash flow statement, I want to come to know whether you understood something or not in the accounting. I don't know. Many people are telling that accounts is new to me, or accounts is not understandable for me. Many of you are telling like that. So I want to know, you have to ask now questions, whatever you don't know for some time. We are not going to teach anything new now immediately. Of course, we are going to have next concept as cash flow statement. We come to it later. Before that, I want to make ensure that you understood something. You are in the accounting class. Something like that. So each and every one of you should answer a question or you should ask a question. Choice is yours. A or B. There is no none of the above. There is no none of the above. In that way, I am going to spend another 15 to 20 minutes time so that I can understand what is there in your mind. Okay? We can start from those who are away from us and trying to be with us. Those who are online. People, those who are online, is it okay for you? Any objection?
Professor, we are unable to see you, Professor.
You are unable to see us,
Yes.
but you are able to hear us, right?
Yes, yes, sir.
Yeah, then technically that is not enabled, I think. Video or visual is not enabled, but you are able to see, right? Sorry, you are able to hear us. We will tell.
Yes, sir.
We will tell the supporting team to make that also arrangement. Now we can start one by one from those who are online now. First person, who is that? Who is this woman? Can loudly say that name? Yeah. Madam, are you there? Can you hear us?
Yes, sir. I can hear you. So you just need to click on the video. I mean, on the EMBA trimester 1. So that is, once you click on that, I think we will be able to see you.
Now we are not letting you to see us.
Okay, no worries, sir.
No problem.
Thanks.
Area, no problem. Now it is your chance to ask one question. Can you tell me what you understood from accounting so far? Anyone you tell and that answer. Any one question and answer. Madam? She is there? Yeah, she is there. Madam, can you please unmute yourself?
Yes, sir.
Yeah. So I think you got the point, no? You have to ask a question. Or you have to say, sir, this is the concept I learned. What is this? Yeah. Or you want to ask a question to you?
Sorry, sir. I'm not able to hear clearly.
Tell me what you understand by accounting. What is accounting according to you?
So far, like accounting, definitely it is tough for me. But yes, I'm not from accounting background. But whatever I have learned from this is the assignment which we had it that taught me a lot, and the videos which you were sharing it, like how to create the balance statement and what is the financial statement and all those trial sheet, all those things I learned how to make it, and I understood exactly like how to do that one. So that helped me. And also you had shared the videos and some of the sites, right, to look at it, so which helped me to learn a lot.
Okay.
So yes.
Just tell me something on that lot.
Sorry,
No, from that lot.
sir, can you just come to the mic, come closer to the mic, because
Sorry, I'm coming here. Yes, yes. I was told that wherever I will be standing in this classroom, it can be audible for you. But anyway, and now I'm better.
yes, it's better.
Can you define accounting? Or what do you mean by accounting? Suppose I'm asking you in exam, what is accounting? What will be your answer? Without referring something, you can just tell out of your mind now. What comes to you if I am asking you what do you mean by accounting?
Accounting is the process of measuring and processing and sharing financial
Process of
measuring. One second, yeah. I don't know what is happening.
process of identifying.
Yes, identifying and measuring and sharing financial and other information about the business and corporations. So that is something
Business
I
and
understood
corporation
about it.
also. Business and corporation or only business?
Businesses, yeah.
Okay, so accounting is a process of identifying,
Yeah.
recording, classifying, summarizing the business transactions in a significant manner in order to understand the result of a business.
Mhm.
Financial data, simply financial data. Fine, that's simple meaning of accounting. Accounting is nothing but a process. Accounting is a process of what? Of identifying business transactions, recording business transactions, classifying business transactions, summarizing business transactions, and finding out the result of business transactions. What could be the result? What do you mean by result of business transactions?
You should know the
Financial position of the company,
Financial
position of the
position of the business and
performance.
performance of the business. I already told you accounting revolves around only 5 terms, five terminologies, 5 words. What are they?
Expense.
profit and
Main important thing you are forgetting. Without that, you cannot start a business at all. Equity, capital. So accounting revolves around only these 5. Recording of the changes that take place in these 5 only is called accounting. Accounting is nothing but the process of identifying the business transaction. What is business transaction? The owner brings money from his pocket and he is starting a business. That's a business transaction. The business buys a piece of land, a business transaction. The business buys some raw material. It's a business transaction. The business appoints somebody and pays salary, the wage. Business transaction. So any business transaction that takes place in the business is to be recorded. Why it's to be recorded? To know the result of that business transaction. To know the result. What is the result? Financial performance and financial position. If I say financial performance, it talks about profit or loss. Out of these 5 terminology, income, expenditure, only 2 we are taking out and we are comparing these 2. The total expenditure that has been spent, that has been made during a particular accounting period of time is compared with total income that has been earned by the same business in the same period of time. If the income is excess, it's called profit. If the income is less than expenditure, it will be called as loss. So measuring profit or loss is nothing but resulting in the performance of the business. Measuring the profit or loss, measuring the financial performance will tell me what is the business is it in loss or it is in profit. Another one is to know the financial position. What is financial position? In the 5 words, 2 we have taken out already, income and expenditure, remaining only 3. The totaling of or the study of or the relationship between these 3 will be called as financial position. What are those 3? Assets, liabilities, and equities. Always at any given point in time, in any business for that matter, asset, the total of assets should be exactly equal to the sum of the liabilities and equities. Why? Why it is so? Next person will ask. Ashok Kumar, can you tell me why always the equation is true? That is, assets are always equal to the sum total of liabilities and equity. Ashok, can you hear me? Mr. Ashok, are you there? Please, those who are online today, we are just going to have this kind of interaction only most of the time. I want to know what you are learning. That's it. Yeah.
Sir, I'm there in the line.
Yeah, I know. Yeah, please, can you just tell us the reason, logic behind the equation called assets are always equal to liabilities plus equity? First of all, will you agree this equation? Have you heard about this equation before?
No, sir, in the class only I was heard about it. There's nothing else, because I'm not in the financial. Hello?
Yeah, please. In this class or previous class?
No, previous class.
Classes. Okay, right. Previous classes. So do you agree that assets are always equal to assets of any business? The total of various assets of any business on a particular point in time should be exactly equal to the sum total of the various liabilities of that business on that point of time plus equity of that business of that particular point in time. That's the statement I'm claiming. How it is
Yes,
true?
sir.
Wait, what is the logic behind it? Why always assets are equal to the sum of liabilities and equities? First is learning. We are memorizing this statement. We are memorizing this equation. We agree that it is to be equal. Then we are understanding what's the logic. Why it should be equal. Yes, Ashok, any idea why it is equal? What's the logic? I was telling this equation from the beginning.
Yes, sir.
Yeah, what is the logic? What is the reason? Don't delay the timing. If you know, please come out. Don't browse or something. You can just go on. Next person. You can ask.
No, sir, we will go on to the next person.
Okay. Anybody from the class? Yes, sir.
The assets,
Somebody from the offline class is trying to answer. Yes, sir.
whatever the money comes into the company is treated as asset, but it is same time it becomes a liability to that firm.
Okay.
Double entry.
Yeah, so that's simple. So go straight, take left, then right. It's not that simple map you are giving. That's it. Simple. What is that?
Double entry.
Due to double entry bookkeeping system. To be more clear, more concise, because of dual aspect concept. Accounting follows a lot of concepts upon which the framework of accounting is built. Basic logic. Okay, one of such logic is dual aspect concept, double entry bookkeeping system. Dual aspect, same thing what is explaining. The meaning is the title is double entry or the dual aspect concept. Explanation is what is called. Okay, I'll try to explain. Each and every transaction will have its own two aspects into it. If both the aspects are recorded, then you call it as double entry bookkeeping or dual aspect concept. Okay, because of dual aspect concept only, when you receive cash from the owner, as capital, the business will treat in two ways. One is the money received actually, that is asset for the business. If the business is closed, that money is to be repaid to the owner. That is liability. Internal liability is called as either capital or in a broader sense equity. Because of this reason, because of dual aspect concept, for any given point in time, for any business for that matter, the total of assets should always be equal to the total of liabilities and point is dual aspect concept. Okay. Next, Srinidhi. Anybody is there by name Srinidhi?
Yes, Professor.
Yeah. So I am just telling about some concept, right? Dual aspect concept. Like that, we are having lot of concepts in accounting. Can you name any two concepts of accounting?
Concepts of accounting.
What is concept of accounting? I already told you. There are some assumptions, there are some logics, there are some kind of prerequisites that guide us to do some accounting, to follow some uniform aspects in accounting, to uniform practices in accounting. Okay. So now I told you each and every transaction has twofold effect. Both the aspects to be recorded in the business. It is to be followed by everybody.
Yes.
That system is called double entry bookkeeping system. Similar to that, we have a lot of other assumptions, we have a lot of other concepts. Can you name 2 of them?
Yeah. Money measurement concept and accounting period concept, I think.
Can you explain these 2?
Yeah. Whatever we do in business, we will measure that through monetary basis, right?
Whatever we do in the business, you have to measure it in money.
Monetary basis.
Okay. Is it so?
And the second one is accounting period concept. For every account, every entry for every account, for every balance sheet, we have the strict term line for that, like year for the 12 months. So for India, we are following April to March, right? 1st of April to 31st of March. That is an accounting year for us. So that is a accounting period concept.
Very good. But first one explanation, money measurement concept is not like whatever we do in business is money, not like that.
Okay.
That has the monetary measurable characteristics, that only can be taken into consideration for accounting. You are appointing a HR manager or you are appointing a marketing manager. He is very honest person, honest. Sir, he has worked for 20 years in the industry. Till now, a small allegation is not against him. Honesty. He'll come to office. If office timing is 9 o'clock, he'll come by 8:55. If office time is 5 o'clock closing, he'll go by 5:15. Punctuality.
Yes.
He never takes leave. Okay, even if there is any emergency in his family, he does not take any leave. He will come regularly to the office, attend the duty of regularity, punctuality, honesty. All these characters is having zero value in front of an accountant. The accountant's question is only one, sir, what is the value? What salary you are going to give him? On 31st March, how much salary you are giving to him? 1,20,000 rupees, including all allowances. That will tell me, sir. Whether he signed? Yes, he signed in the document. Salary account debit to bank account 1,20,000. That's all. Another manager is there. You will come 10:30. Office starts by 8:30. You come by 10:30 only. You will leave by 3:30 itself. 5 o'clock is office time. You leave by 3:30. Every now and then you will take leave. One day grandfather, one day grandmother died. Every now and then you will take leave. He will not stick to one company. Every 6 months once he will change his job. Not a problem for accountant. If he's coming late, is there any salary loss of pay? If it is there, deduct it. Tell me the amount, how much you're paying. That much I will record it. Salary account debit 1 lakh, to cash account or bank account 1 lakh. 20,000 is taken away for delay in work or loss of pay or whatever it is. That much only recorded in the books of accounts. His honesty, his sincerity, his regularity, his qualities are all immaterial for accountants. Similarly, any transaction that took place in the business organization, which are having the characteristics of measuring in that alone can be recorded in books of accounts. That is what propounded by a concept called money measurement concept. Okay, either we have only other concept. I think you are able to understand. Okay, you have to understand the basic concepts. Okay, next. Swati. Swati, are you there? Yeah. Swati, are you able to hear us? You are not audible. Swati? Okay, Swati is having some problem in audio. Anybody from online? Anybody would like to ask any question or any answer? Zakir Ahmad. Can you hear me?
Yes, sir.
So what is journal? Have you heard about the term journal before? What is journal?
So,
Yes, journal.
journal is a detailed record of all transactions.
Detailed record of all
transaction
Transactions.
according to the business.
Okay, can you tell one transaction and how it is entered in the journal? Can you tell one transaction and tell me how it is entered in journal? Suppose cash deposited into bank. The business is depositing cash into bank, 50,000 rupees. What would be the journal entry now?
Yes.
Yes, sir. So we are not getting you. Okay, bank account debit to cash account. Bank account debit to cash account. Why this is? Based on the rules of accounting. What are the 3 rules of accounting? Nominal account rule, personal account rule, and real account rule. In this journal entry, what rule I applied? Personal account as well as real account. As per personal account, debit the receiver. Who is receiving? The bank is receiving money from the business. That is why bank account debit. SBI bank account debit. ICICI bank account debit. To cash account. Credit what goes out. As per the real account rule. Okay, 3 rules are there. Nominal account, real account, and personal account. Personal account rule says debit the receiver, credit the giver. Nominal account rule says debit all income and debit all expenses in credit all income and gains. Then real account rule says that debit what comes in, credit what goes out. In any transaction, while recording in journal, you have to follow this rule. While recording only in journal, you have to follow this rule. These rules sometimes can be applied individually based on the transaction. Sometimes the combination of 2. Now in this example, combination of 2. Bank is a person, cash is a real. So both combination. One debit comes from one account, another credit comes from another account. Okay. So journal. After journal, what we are doing? We are doing ledger. What is the purpose of ledger? Classification takes place in ledger. In journal, we chronologically one by one write all the entries. In journal book, we are writing all the entries one after another based on the time of occurrence. What occurred first, we are writing first. It goes on like that. We can't come to an understanding that how much cash is available in the business today. Cash in hand. The owner wants to know what's the balance, cash balance. Accountant may not be knowing it. Of course, he may know by counting it. Physically, he can count and tell. Some 1,20,000 is there. He can say. But according to journal, we cannot come to know how much cash available. There's a person called Rajesh. He is your customer. Owner is asking you. You as an accountant. He is asking you how much money is still due from Rajesh. Who is Rajesh? Customer. You sold goods to him on credit basis. You want to know how much money is still due from Mr. Rajesh, who is a customer of you. In journal, you cannot find out. So what you do? You have to prepare a ledger. A ledger is nothing but summary of an account of only one nature. Rajesh, all Rajesh related account will come there. What you gave to Rajesh, what you received from Rajesh, everything will be in one place in the name called Rajesh account. Similarly, Ravi, who is a supplier for you, you want to know how much you have to give to Ravi as a final settlement. You bought goods from him on credit, you paid money, you paid a check. It's going on like that. Discount received, many things are there. Finally, you want to know at the end of the year, or at the end of the week, or at the end of the month, you want to know how much still to be settled to Mr. Ravi, who is your supplier. It cannot be known from journal. You have to prepare Ravi's ledger account. Similarly, bank account, cash account, capital account, financial account. You name any account in ledger, sorry, in journal that need to be in the ledger in one place. Wherever cash comes in journal, we collect all those entries and bring in one place. That one place is called cash account. Wherever purchase is there in journal, we collect all those things and record it in one place called the purchase account. Like this, you have to enter as many ledger accounts as it is there in the journal. Okay, the purpose is to know the net effect of the particular account. Net effect, cash, how much, bank, how much, Ravi, how much, like that. Clear to you? So ledger. After ledger, what are we doing? Trial balance. Why are we doing trial balance?
Arithmetic accuracy.
Huh?
Or arithmetic accuracy.
To arithmetic?
Accuracy.
What is that? One word is missing. Why do you prepare trial balance? What is trial balance? Trial balance is nothing but a statement. Statement which contains the balances of ledger account on a particular point in time of a business. Okay. Why do you prepare trial balance? Anybody from online would like to take this? Why do we prepare trial balance? Trial balance. Yeah, we have a point. We have a really we served a purpose. If this girl is understanding, this is not the answer for this question after 2 minutes, then our class is having a purpose. Unlike they're trying to answer. Yes, sir, please.
Yeah, sir, we do a trial balance to make sure that whatever ledger entries are there, they are correct and appropriate.
Okay, correct and appropriate. Okay, so simple word is to check the, to ensure the, to confirm the arithmetic accuracy. What it told is to arithmetic accuracy. Actually, to ensure, to know, to find out, to confirm the arithmetic accuracy. Trial balance is the statement. Madam, listen. Trial balance is prepared to make sure or to know. What is that? Arithmetical accuracy. What is arithmetical accuracy? Arithmetical accuracy is number? English also I should teach you. No. You are knowing. Arithmetical accuracy. What is arithmetics? What is simple? No? Addition and subtraction is arithmetic, basic arithmetic function. Arithmetical accuracy. We have done so many addition, subtraction in the journal entry ledger account. In ledger, what do you do? You add one side, take a total. You add another side, take a total. Match each other. And you find out the difference. How do you find the difference? From the highest amount total, you subtract the lowest total. The difference is there. So the subtraction is happening. Addition is happening. So it's called arithmetic operations. Whether you have done it correctly or not, that is going to be checked in one statement. The statement is called arithmetic, trial balance. So trial balance is a statement which contains the balances of ledger accounts of a business on a particular point in time in a format. Why it is prepared? To check the arithmetical accuracy of the books of accounts. If total of trial balance debit side and total of trial balance credit side matches with each other, tallies with each other, means we can say that there may not be any arithmetical inaccuracy. Look at the English. We can say that there may not be, I'm telling there may not be, there may not be. I'm not telling there should not be. Maybe chances are there. See, there are some errors, compensating errors are there. Instead of debiting furniture, you debited purchase. You are buying furniture. Original entry should be furniture account debit to cash. But the poor accountant, what he has done is purchase account debit to cash he has written. Amount is the same. 10,000 is a purchase of furniture. You are not a furniture vendor. You are just a college, or you are just a manufacturer of computers. You are buying furniture. Furniture is an asset for you. So what the right entry should be? Furniture account debit. Debit what comes in. Furniture has come in, so furniture account debit. To cash. Credit what goes out. Real account rule. Both applies here. Debit credit both applies here. Okay. So furniture account debit to cash. It should be. But the accountant, without knowing that, he written like that. So purchase account debit to cash. It will never be disclosed by trial balance. In trial balance, debit totally same, because instead of furniture, it is there in the name of Purchase. Both are in debit side only. The total of debit side will not differ, will not change. So that kind of errors will not be disclosed by trial balance. But nowadays, everything is in ERP. We are doing it in computerized accounting. But again, there also some person should enter the first basic entry should be done by somebody. For the voucher, somebody might have opened Tally right in the beginning. Now Tally ERP Prime is there. Some companies are following. Very small companies, bigger companies they have their own ERPs. Okay, or SAP or SAP their own. But anyway, somebody should feed the data. That is compulsory. While feeding it, if you are giving wrong, then it will be an error. Okay, the error is either maybe a compensating error. This is compensating error. What's compensating error? Instead of furniture to be debited, purchase has been debited. Something to be debited, something has been debited. Compensating. One debit is not done, but some debit should not have been done, but done. Both are compensating each other. Trial balance will not worry about this. Will not know about this. So trial balance is agreeing means I cannot assure that there is no mistake at all. Only arithmetical mistake, arithmetical error can be identified. Okay, that's the purpose of trial balance. After trial balance, what are you doing?
Financial statement. Financial statement.
Verb you don't use, only noun you use. Only noun you use. Directly you go into the main hall. Huh? Preparation of that's a verb, no process. Of course, right. In the diagram, next one is financial statement. Preparation of financial statement. Okay. What is financial statement? Income statement, balance sheet. Income statement and balance sheet. These two are the basic financial statement. Why these two are prepared? Now connect this with the basic objective of accounting. What is the purpose of these two statements? Income statement or P&L account is prepared only to know the financial performance, profit or loss. Balance sheet is prepared to know the financial position, which talks about assets, liabilities, and okay, up to this one area of accounting called financial accounting. This is purely internal. Internal people do this. After this, we people, outsiders, maybe investor or management. Of course, management is internal only. They want to know what has happened. P&L account and balance sheet gives you what has happened for that particular year. That's it. Whether you are improving or not, or you are declining in your performance, are you comparable with your market competitors? Are you doing outperforming the market, or are you doing on par with your competitor? All those things can be analyzed. Such analysis is only done in the financial statement analysis. Second stage. One stage is completed. Second stage. To analyze the financial statement, what we need only financial statements prepared by an accountant. We take the statement, we try to connect one variable with another variable, try to find out some deeper insights about that company by applying some logic. One of such logic is ratio analysis. One of such methods is ratio analysis. Okay. Fine, we can go on to the next one, new area. Anybody has anything to ask up to now, up to last class? You have to prepare more. That's why, otherwise, if you are not preparing, you cannot understand this logic. Yes, sir.
Yeah, I'm not very clear on this viewpoint analysis.
Okay, last week we talked about simply, yeah. You want to say something on that? I mean, you want to know something on that? Anybody? Two-point analysis, self-study. I'll send the video by evening today. You go through that. Simple logic, one more understanding is, okay, it's not there in our syllabus, but it's important actually. Simple. See, sir, your BP is this much, your blood sugar is this much, your heartbeat, so many things you are telling about the person. He is getting confused. So many numbers you are telling. I don't want all these numbers, sir. You tell me only one number, am I healthy or not? You are telling so many numbers. I'm confused actually. Numbers will always, figures always will take for misleading because it will misguide us. Okay, right? Numbers, so many numbers are telling. So maybe only one number or in sentence. In text, good, not good, or okay, or not. Something you tell us to understand. That is what DuPont analysis. Okay, by taking all your ratios, what you computed so far, okay, they take that and they give it in a simple understanding whether the company is performing better or not. For that, they have a logic. That logic is DuPont. It's a company name. DuPont is a company name. They found the logic of bringing a single number. Suppose I'm giving you marks in accountancy 23, HRM 43, like that. We have so many marks. 4 semesters, 6 semesters, you are studying a course, a program. Finally, I want to give one mark sheet. What's the percentage of marks? I got 82.2% out of 100. That tells about your performance. Is not telling sir English 32, Hindi 41, accountancy 31. By the time the recruit will go to the next college to recruit somebody else. You tell me only one. Sir, this is one. If they ask in detail, then we can go for detail. So that's what simple understanding of DuPont analysis. And there is another concept I told you. Altman set score. That's not the same thing. Okay, to know the bankruptcy position of a company, okay, we can find out Altman Z score. Altman, there is a professor called Altman. He found out the logic of Altman Z score. That score he found out. He found out that, so he was named after his name. Altman Z score. What it says to us is Altman Z score. You can browse it. What it says to us is whether the company is now bankrupted or going to bankrupt or it is strong. Level of bankruptcy. 4, it is dividing into 4 categories. Bankrupted, gray zone, something is telling the zone, the number, based on that number, that value. Is asking you to calculate that value by applying these ratios in a discriminant analysis. It's taking some constant and is giving its number. He's trying to ask you to multiply. If you multiply and add it together, you'll get one single number. If the single number is more than a standard number, is classifying the numbers into 4 categories. Okay, 0 to this much or less than this much. That is classifying. Based on that, is categorizing the companies. That's called Altman. That's called. Like there are so many latest techniques, not latest, but modern techniques they will call it as, but it was identified long back, 70s, 80s, and 90s. That's not. There's one more concept called M score. M score. M score talks about the window dressing of the company. If the company is window dressed or not, how do I find out? A person is coming, by looking at him, I find he's a wealthy person, I'm telling you. But is it really a wealthy person, I have to check it. For that, we have a concept called M score. Okay. M value, if you find out, that really tells you whether the company is dressing up its financial data or real data is there. Okay, these 3 are out of syllabus, not for exam, but you read and understand what it is.
So by judging, by looking at the balance sheet of the company, can we ascertain that whether it is going, as far as bankruptcy is concerned?
As far as
bankruptcy,
yeah,
whether by looking at the
balance sheet,
can we guess it, or balance is not related to bankruptcy?
no. Suppose your friend is coming in RD car. RD car. Okay. Okay, with full coat suit and everything. Okay, he's taking you to a 5-star hotel and treating you. Can you immediately come to a conclusion that he is rich? Not necessarily to be. He may be in real case. So balance sheet gives you the basic idea about what the company is. Then you have to analyze.
Because balance sheet includes the
assets, liabilities.
Also,
yes. Yeah,
also,
liabilities.
Assets also.
Yeah.
So whatever I am dealing in my business should be recorded in the balance sheet.
Definitely.
So then I cannot ascertain that position.
Example, anybody would like to take this? I am not telling you cannot assess at all. Not necessarily to be. By looking at the balance sheet itself, you cannot come to a conclusion that the company is good company or not. Again, what point you are going to assess? Assessing is a common broader term. What are you going to assess? Based on that, I will go in deeper. What do you want to assess?
Normally, what by looking at
Balance
balance
sheet.
sheet, we can assess is normally if it is healthy, then we insider fund should be more than the outsider fund in the balance sheet.
Insider funds should be more than the,
Lenders or the loans.
so equity should be more than liability.
Liability.
Just now we discussed it should not be.
No, that is again risk.
Yeah, risk. You take risk now. Today Sunday. We can enjoy. But we are not doing it. We are taking risk. We are coming here. We are transacting something. Right? Why? You. No, no, no. No. Since you agreed to come on Sunday, you paid. Since you paid, you did not come on. You are not coming on Sunday. Understand the logic? Simple logic. Since we agreed to come on Sunday, we paid. That's it. Why we agreed to come on Sunday? We are taking risk. Why? Why that risk only you are taking, not all of your colleagues are taking a company? You are greedy. Okay, you are greedy about knowledge. More knowledge you want. Okay, you are greedy about improvement. Okay. In a normal life, in a materialistic life, everybody is like that only, including the way I'm coming here. Suppose tomorrow they're telling you, sir, come every day, every Sunday, talk to our student and go. That's it. Will I come? Materialistic world, compensation is required, right? So to answer your question, by this time you have understood. Taking risk is a part of life. If you're thinking that I have 1 rupee, I borrow only 50 paisa. That's left to you. Nobody is compelled, no accountant is having a right to compel you. Sir, you can borrow more. No, it's you who's deciding. Finance man, the company is deciding. If it's sole proprietorship, sole proprietor is deciding. Sir, I have 1 rupee equity capital. I want to borrow only 50 paisa as loan. I don't want to take risk. If anything happens in the future, I can just give that 50 paisa from my own 1 rupee and I can go out. I won't affect anybody. That's the characteristics of that company. That company is called unlevered company or less levered company. Any company does not borrow any single rupee is called as unlevered company. You'll study about that in the next semester. I just leave it up to 2 minutes and then I leave that. Any company which is using less capital as borrowed capital is called as less levered company. There are some companies, what they will do, they'll have only 1 rupee, they'll borrow 10 rupees.
From investor point of view, which one is good?
Yeah. Now we are coming to the point. I asked what point of you look at my question. What do you want to analyze? I asked the question. Now you come to a point. Investor. Who is the investor? Which investor are talking about?
Banks, lenders.
Okay, lenders. Lenders. For lenders, I already answered to you in the beginning. Lenders, which is having a less borrowed capital, I will go and lend more money. I'm not taking much risk. Okay, I will lend money. Suppose already 1 rupee is equity, 4 rupees borrowed money. They are coming to you to ask 1 more rupee as loan. Will you give? If you give, you are taking more risk. As a bank, as a lender, you are taking more risk. What do? You charge interest more. You will ask rating more. So you are rating more than this, you come. Otherwise, you don't come. So there are so many hurdles will come. So from which point of view you are talking about, that is very important. As a lender, if a company has more debt than its equity, it is not advisable to lend much. Simple concept. It's not even financial management, it's a normal concept. Normal concept. If any person has already more debt, will he give debt? No. Another one, as an equity shareholder, if a company is already having more debt capital, I should not go to the company. If I go, my 2 points are there. One is, if the company earns more and more money, I'll get more. Interest is less amount they'll pay, remaining all comes to me as a dividend. But the company is not even able to manage their interest from the profit, I will not get anything. All the earnings will go to interest only. If it is not more than interest requirement, we have discussed one ratio, right? Interest coverage ratio. At least your profit should be equal to the interest what you are supposed to pay. Then you are safe. If not, the interest itself is 1 lakh, but your profit is only 70,000, means 30,000 rupees you are going to pay from capital. If you keep on doing that, one fine morning, your full capital will get eroded. full capital will get eroded. You are leading to bad debts eventually. Okay, got it? Any other point from online? Anybody? Any other point of discussion? Okay, come to the assignment. With that, we can finish this and we can go for the new chapter. Assignment number 2. I think by this time you might have seen it is open. Not seen? If not seen, you can see later. Okay, assignment number 2, it's about financial statement analysis. I'll give you 2 minutes time. All of you can take your mobile or you can take your laptop. You can just check the assignment, what is uploaded there, and we can discuss. 2 minutes time. You can go through that. So for online, please take your mobile or laptop, go through the assignment that is kept in LMS for 2 minutes, read it, try to understand, and then I'll explain to you for 2-3 minutes. These videos I'm sending you, please see that. Those are especially non-commerce students. See that. Not only sticking to that video, you can see any other videos also on accounting for basic understanding. Wrong line. Are you able to hear me now? I think it was muted some time back.
Yes, sir. Yes, sir. We can hear you now. Now we can hear you.
4 to 3 minutes does mean right.
Just one.
Yeah. Any doubt is there? Please, you can ask me on item number 2. Yes.
Is it preferably the manufacturing company or is it service company?
It should be manufacturing. Preferably age group sale. Why I am telling this is manufacturing companies will have more information on production process. Raw material will be there, stock will be there, wages will be there, all those things. Service companies, of course, service companies are having slightly different ratios. If you go and take bank, insurance, all these companies, they are all specialized businesses. Service business, specialized service business. We cannot just apply the ratios what you learned here to an insurance company or to a banking company. That's all.
Regarding manufacturing, we have all the transactions, purchase return, sales return. So we have, family, but as far as IT industry is concerned, for the accounting, I'm not very sure how the transactions, because the service, the vendor the service, and if there's any problem, how they reverse it, how they will account in the accounting and all. So
anybody from IT companies sitting here? Yes, sir. Which one? No, which one is this company?
L&T technology.
L&T Tech. What do you do actually?
So engineering.
What's the business model of the company?
Engineering service.
Engineering service. Okay, what clients will be other business. Okay, so suppose a business is there, if they want some IT service,
So we do it for telecom, for the automotive.
Okay.
Even all the entire transportation. We work with aero, airline.
Instead of sales, it is revenue from operations. Okay, it's from sales. They will debit the customer. The company, what is there, we raise invoice on them, we debit them. Okay. The value of how much you agreed upon both the parties. It's not sales, it will be revenue from operation, to revenue from operations. Okay. There's not much difference in the basic logic of accounting. But the heads of account will be different. Heads of account.
it's of accounting and the entries.
Entries based logic is different. Same no. Heads of account different means the name of the account only in journal entry or writing.
Vendors will be less.
Yeah, vendors will be less because they don't have more suppliers for them. No, more customers will be there, more client will be there. Okay, so it's service based. I don't find any much difference. What is the name of the account will be different. Salary there on the salary will be there. But only raw material won't be there. Okay. Even in manufacturing company also, if you go with this knowledge, you cannot do the account. The heads of account who is deciding? The accountant is deciding. That is being entered in the ERP at the beginning itself. You will not write the entry again and again the same thing. Automatically it will be there. Suppose you have 10 vendors means already 10 vendors names are already recorded. If you click first letter of the vendor, it will come automatically. If it is same, you got to click on that. Otherwise, you have to type again. New vendor to be added. Okay, service companies will not have much inventories, raw materials, finished goods, but receivables will be there for them also. Payables will be there for them also. Utility bill they have to pay. Many of them will be there. Same. Only thing is utilization of assets. Okay, they may have some service industry, exclusively IT industry means many softwares will be there. Okay, there will be equipments, plant, it won't be there. Okay, service companies will not have any equipment.
Equipments will be there. We would buy on
What equipments will be there? Computers will be there. Yeah.
Yeah, when we buy on behalf of customers providing a service.
So you are not just a service company, you are providing that also. So see, it's a learning driving first. See, in a small gully road or small road, how do you drive? After getting into the seat of driver, in that road you will learn. Okay, so that it will be easy. That's a point. Okay, so we can break for some time now. Then we can come back and start with the cash flow statement. Very important aspect of financial statement analysis. Before we close for break, anybody is having any doubts? Those are online regarding assignment number 2. Because I don't want you to get confused after it is asked to do. You are raising so many concerns in the group. That time I was not able to answer from that. Anybody? Okay, no. If you're still having any doubt, another 1 or 2 days, you can ask me personally to my WhatsApp number. Then you have to start doing it. Okay. Thank you. See you after the break.
Hello.
All right. So we discussed there are so many tools available for analyzing the company financial statement. One of the tools we already discussed last class, that is ratio analysis. Now the another tool is cash flow analysis. Cash flow analysis. We have cash account, we have cash book. So what is the need for having some more statement called cash flow statement? In cash account, the ledger account of cash, we write all the inflows and outflows of cash as and when it is taking place. Some companies may not follow cash account separately as a ledger account. They may have a subsidiary book called cash book. Cash book also does the same purpose of recording the inflows of cash and outflow of cash of a particular organization during a particular period of time. But what is cash flow statement? Cash flow statement. See, cash account or cash book does not categorize the inflows and outflows based on some logic. It just states all inflows and all outflows. You can just imagine, I can just guess some inflows and outflows of cash of a business. What is flow? Movement. Cash flow. Here cash refers to hot cash as well as the cash and cash equivalents, bank balance, and any other cash equivalents what we have. Okay, it's not just hot cash, it includes
Current asset.
cash, not current asset, not complete current asset. Cash equivalents. Those who are online, can you hear me properly?
Yes,
Yes,
sir.
sir.
Okay. So cash
Yes,
and
sir.
cash equivalents, check, draft. You received a draft from your customer. He has to give you 10,000 rupees. He has given you a draft. Demand draft, banker's check he has given. Or you received a check itself. Or he has deposited money into the bank. Or he has given you hard cash. In all this form, we call it as cash only in this context. Cash refers to hard cash, cash in bank, cash in the form of demand draft, cash in the form of any other cash equivalents, which can be accepted as cash by your another party to whom you have to give money. If I receive a check from you, I can give the same check endorsed to some of my supplier to whom I have to settle some money. So these are all called as cash equivalents. Okay. Now, cash flow. Flow means current. I mean, inflow and outflow. Your flow is there. Okay. You take a business, any business for that matter. What are the various possible ways in which the business will receive money or the business has to pay money? Can you just guess and tell me? Where and all, or through what and all, a business can receive money? Receipts. Inflow. Receipt means inflow. Any example? Sales made to a customer on credit. Is it a cash inflow?
Yeah.
Then it says fully. Sales made on cash. Is a very basic inflow of cash to a business. Okay, then. Sale of assets for cash. Sale of assets for cash. But it will take place every day. It may take place sometime, but it is not a regular phenomena of a business organization. But sale of goods on cash is a regular phenomena, but it's also taken. Yes. Sale of goods on cash. Sale of asset on cash. Is it inflow or outflow? We are talking about inflow. We'll come to that. Commission received in cash. Okay. Yes, sir. Sorry. Investments. Investments to the business. What is that? Partners are investing into the business. Okay. Now we are talking about company form of organization. Company. Once again, let us settle that. For a company, what kind of money will come in the way of investment? Sale of shares to the shareholders. That's investment. Shareholders are investing money into the company at the time of opening a company, starting a company. Later, if you buy share from somebody and sell shares to somebody, means that is not a inflow and outflow of a company. I buy ICICI share 10 shares today from my friend or from some unknown person. Between both of us, this transaction is going to happen. It is not between me and the company. This does not result in inflow or outflow of cash for a company. Sale of shares in the IPO. Okay. Anything else?
Food sold of rupees so and so, and they issued by check that whatever the amount.
First, you only told no goods sold on cash.
Food sold for rupees so and so, issued by check that amount.
How does it differ from the first one what you told? Goods sold on cash.
Here we are not directly receiving cash, but check.
But in our discussion, cash means we already defined now.
Just I'm telling one more
That example is already there in the first example.
example.
Then you'll say commission second received, commission 3 received. True. Check received for sale of goods. That's nothing but cash sales. In this context, it is cash sales. Whether you receive hard cash, whether you receive in bank, whether you receive in check, whether you receive in demand draft, all put together we call it as cash only. Yeah. Anything else? Sorry? Refund from? Refund from whom? Supplier. Supplier is refunding you. Okay. Refund from supplier. Refund from IT department. Income tax department refund. Okay.
Issuance of debentures.
Issuance of debenture is another example for cash inflow. Issuing debentures. Very good. Next. Okay. Taking loan. Simple. Taking loan. Increasing our cash flow. Taking loan. Issue of equity, issue of debentures, borrowing of loan, sale of goods, sale of asset, receiving commission. What is that? What is your day-to-day activity?
Like, if I'm producing some product, let's say bikes, and they are selling it every time, they will get.
You already sold now. That boy already sold your bike. He sold no. He did not say what he sold. Goods he told goods. Goods happening to be a bike in your case. In my case, it may be a car. In other case, it may be a furniture. Sale of? Yeah, true. You can do that. No problem. But this has been already discussed. I'm telling. I'm not telling it is not a cash inflow. It is a cash inflow. But that cash inflow is already discussed. Sale of goods. That goods happening to be a bike in your case. That's it. In general parlance, it is goods. Okay. Anything else? One very important point you are forgetting. Okay, take it. Dividend receipt. Possible, right? You invested in some other company's equity share, they are giving you dividend. You are getting it. Cash inflow. Good. Any other thing? Very routine. Sorry? See, good company you are. I have to come and buy goods from you only. Sir? Sales? Already sold, na, sir. Hey, all of you, please be with me. Don't sell the goods separately. We all sell the goods together. Yes, sale of goods is good example. On cash, already taken. First is that only. Anything else? Advance received. You are a good company, no? Advance you are receiving. Pay 20,000 rupees. I will supply your TVS, iQube, something. Yeah. Getting advance from customer. Sir? What is that? What is that?
Profits.
Where you get from? So what is it called? Basic accounts you have to understand, man. Please understand. See, I am giving this material to you, collecting 10 rupees from that, from you. The 10 rupee, if it is more than the cost what I bought this one, it's a profit. 10 rupees is 10 rupees, that's all. That's nothing but cash received from sales. That's it.
But one more concept is a return on investment. So if I'm investing outside,
Okay.
again, what dividend it said.
Yeah, accepted, no?
That is also that point.
No, that is not he's thinking. He's thinking about profit. Yeah. But you have to be very specific. Dividend received. You can say interest received. I will say yes. I can't say no. Interest received. Anything else? One important thing you are not telling. Think. Cash receipt for a company. Sorry?
Investment capital.
I already told no, that equity. While starting the business, all the shareholders bring money. Yes. Very, very important one. Daily it will happen. For that only business is today life. Today's business are relying upon that only. Huh? Sorry, sir? Collection from customer. Today, if you say cash and carry, nobody will come and carry your goods. They ask only for credit. You are selling it today. You are collecting from customers later. More than cash sales of a day, collection from customer will be more. Collection from customer. So collection from customer is another day-to-day routine cash inflows of a business. Anything else you forgotten? Yeah, now he is going to accountancy. Yes, it is included in sales account. Sales account credited. Customer account is debited. Customer to sales. But in the first case, cash to sales. In that case, cash is affected. We taken it. But in this case, it is not affected cash at the time of selling. At the time of selling, there is no cash coming to you. When it is coming to you? At the time of collection. Cash account debit to customer account. For accounting purpose, the value of goods already included in sales. Sales is sales only. It's whether credit sales or debit sales. I mean, cash sales, no matter. You're confusing me. No matter. Okay. Sales is sales. It includes all the sales, credit as well as cash. But when it comes to cash inflow, if it is sold on cash, I will receive immediately cash. If it is sold on credit basis, I have to wait for some time. I have to receive cash. Similarly, I might have sold long back, 2 days back, 1 week back. That money will come today. Collection from? It's called collection from customers. Collection from customers. Okay, these are all the various possibilities of inflows. Come back to the other one, that is outflows. Those who are online, please, it's your chance now. Outflow. Can you tell me some examples of cash outflows? Very simple, right? Yes, sir. Those who are online, can anyone come out with an example of outflow of cash of a business?
Paying of loan.
Sorry, sir.
Paying of repayment of loan.
Repayment of loan. Good citizen of India. Repayment of loan. We have to repay. We have to repay the loan what you have taken. That is one of the outflows. Very good. Next.
Paying to vendor for which some services has taken.
Payment to vendors.
Yeah.
Yeah, very good. Payment to vendors from whom we taken some service long back or some goods long back.
So salaries, wages.
Salaries, wages, payment to our employees and workers. Very good. Excellent.
Money used to purchase any fixed assets.
Madam, purchase of fixed asset for cash. For all money is only used. So purchase of fixed assets for cash. Very good. That's outflow of cash. Very nice. Next. Listen to them. How they listen to you, madam. Listen to them. Yeah. Yes, madam. Yes. Anybody from online? Payment to vendor, payment of salary, repayment of loan, purchase of assets. Anything else?
Any transport costs.
Okay. Payment of traveling expense.
Tax payment.
Sorry, sir.
Tax payment.
Payment of tax. Very good.
Insurance.
Payment of
Rent.
premium. All right. Anybody?
Rent.
Insurance and payment dividends.
Payment of dividend to our shareholders. Okay. Payment of dividend to our shareholder. Very good. Next. Anybody? Anything we left out?
Rent.
Payment of rent. Okay. Payment of rent, payment of insurance, payment of salary, payment of wages, payment of commission, payment of interest, payment of etc. Okay, next. Any other thing?
So this, can we consider this depreciation and discount allowed? Is it not because we are allowing just discount, but we are not directly paying the money, so it is not coming the flow of the.
Yeah.
Even depreciation also saying, so we will not stay, make them outflow of the cash.
Yeah, there's no outflow.
Yes. Just it is expenses to the company, but we are not paying it. We are allowing.
It is not even expense. It is neither an expense nor an income. It is the accountant who minuses some amount from the asset and telling that it's a depreciation, minusing from the profit. Charge against profit. Simple, straight to the point to your question. I'm confusing you always. Straight to the question, it is no. It's not a outflow.
It's not a cash.
Yeah, it's not outflow. It's a non-cash expenditure. In your language, it's a non-cash expenditure. Since you say it's expenditure, non-cash expenditure. Only book entry we are doing. Depreciation. Okay, next.
Payment for penalties.
Sorry, sir?
Payment for penalties.
Yeah, Indians, no penalty. Okay. not filing the sales return on 10th of every month, GST return. Nowadays,
Payment
GST,
to vendors.
yeah, payment to vendors, yes. GST return not filed on time, we are paying penalty.
Sir, interest paid to bank.
Interest paid to bank, very good.
Insurance dividend. Insurance dividend.
What is insurance dividend?
So we will take, if company starts, we will make the insurance. Sir.
Yeah.
If company go into the bankrupt, we can claim for the insurance. Sir.
No. Which company is giving you such kind of insurance? If that is the case, I will start 1,000 companies per day and I will claim insurance. No. Is it so? Any companies, any insurance companies are there to give you compensation when a company goes for bankrupt? Asaf, I don't know.
There are some, financial institutions or government institutions which provides the security. If the company fails, also they will, share some risk by ensuring, they're taking the policy of that. So to boost the,
Entrepreneurship. But I don't know. But anyway, insurance payment is an expenditure. Let us, I have to complete this. I also read it. I'll see, is there any possibility of insuring our business on bankruptcy? Business can be insured for commodities, for assets. Matter of insurance should be there. Matter of insurance, subject matter. What is subject matter? Furniture can be insured, subject matter. Yeah, a person can be insured. Subject matter is life of the person. Okay, let us not deviate from that. As you told, insurance payment of insurance premium is outflow. Already we discussed that. Dividend already we discussed. Dividend paid already we discussed. Yeah, dividend paid is an outflow. What is dividend? Part of profit given to the shareholder in the form of cash is called dividend. That is outflow. Very good. Next. Okay. Any expenses paid in cash. Miscellaneous, sundry, petty, tiny, everything put together. Donations given, outflow. Any? Another one or two will close it. Anybody from online would like to take anyone?
So incidental expense?
Incidental expenditure. Okay, incidental expenditure, domestic expenditure, any expenditure accepted. Any expenditure paid in cash is an outflow of cash. Anything will be missed out? Any important thing?
Transport cost.
Transport cost, payment of traveling expenses. Okay. That's outflow, right? Investing in other companies, buying the shares of other companies, buying the shares of other companies, or starting a subsidiary company. Good. Outflow of cash. Anything else? Okay, so we have some list of inflows and we have some list of outflows. In your cash account or cash book, we don't even think what for this money is going out and what for this money is coming in. You just write it in cash account. If money comes in debit side, you write it. If money goes out, you write it in the credit side. And finally, you find out the total, both sides, and you match with each other, you find out the balance. That's the purpose of cash account or cash book. But the purpose for which you are spending, the purpose for which you are receiving, that need to be analyzed so that I can understand which purpose is giving me more inflow or which purpose is resulting in more outflow. For controlling my cash inflows and outflow, or to have supervision on my cash inflow and outflow, or to know how much my cash flow is in this particular year. How much was my cash balance in the beginning? Because of this 1 year business, how my cash balance is changing to initial balance. From where you can get the initial balance of cash? From where you can get the amount of cash in the business in the beginning? Which source will tell you about the cash in and about the bank, about the company?
Investors.
Question. From where you refer this amount of cash in hand of a company?
Balance sheet.
Balance sheet. If you want to talk about anything about company, you have to go to balance sheet. If you go to balance sheet, current asset side, there will be a sentence: cash and cash equivalents. That's a part, right? Under that, there will be some amount. That amount is the closing balance of that year. Opening balance for the preceding succeeding. Okay. Now, how much this is going to change? Through balance sheet are taking. Last year balance sheet, Tata Power, 2 crore is the cash in hand, a cash and cash equivalents. Current year it is only 1.5 crores. We cannot simply come to a conclusion that this company has not performed well because cash in hand was 2 lakhs. Now it is 1.5 only. Or other way around. This company was not doing well before, now it is doing well because of cash in hand is. We cannot jump to a conclusion like this suddenly without analyzing it. For that analysis only we are using the concept called cash flow analysis. What are the ways in which you received cash? Cash inflows were there. What are the ways in which cash goes out? Cash went out. So opening balance plus or minus cash inflow or outflow should be equal to opening balance. 2 crore is the cash balance available in the company. Plus or minus inflow and outflow in the year. Inflow is plus, outflow is minus. Opening balance plus or minus inflow and outflow is equal to should be equal to closing position. Now these two I know from the balance sheet. Balance sheet of last year we talk about opening balance of the current year. Balance sheet of the current year we talk about the closing balance of the current year. In between what happens, I have analyzed. And then tell me what is the reason why it is changing. Is it good or good? Now you have two lists with you. What are two lists? Inflow and outflow. Okay, just 1 minute. I'm showing this from the beginning, but I'm not explaining anything on this. Look at this. Cash flow statement is a summary of cash payment and cash receipt. Cash payment. This is payment, cash payment, and this is cash receipt. Summary is a statement which shows the summary of inflow and outflow of cash with the opening and closing balances. Okay. Why do we do this? I already told you the benefit. Okay. We have now two lists, inflow and outflow. These inflows are from many sources and outflows are also too many places, too many reasons. Okay. Now we are grouping them into 3 categories. Goods are getting money. This is a day-to-day activity. You are selling your fixed asset and getting money. Is it a day-to-day activity? Suppose India is selling all the PSUs one by one. We started already. We started. So we are selling. That much we created. But now we are selling it again and again. Now India wants any private companies. Is there? India is one any? No. Indigo is. Air India only we have. That was big donated. Big sold. Finding up. Sorry? After those things. There is us. We don't only want any airline companies. Okay. So many are selling. My point is, if you sell every day one fixed asset, finally you won't have any fixed asset at all. So normally companies won't sell fixed assets in general. In general, if it is waste, if it is technology change, I want to upgrade my technology. That time I'll sell the fixed asset and buy one more fixed asset. Replacement of asset. Okay, so that is not a day-to-day activity. So we are categorizing into 2 categories. One is operating activity, buying material, payment of salary, manufacturing expenses, selling of goods. These are all coming under one category called operating. That's the core of your business. For that only you are there. That is called operating. Another one. If you need money for all these things, no? You are collecting money from so many people. Capital, loan, debenture. These are all called as financing activity. Look at this. Financing activities. Cash inflow and outflow due to because of financing activity. What is financing activity? Increase in your liability or decrease in your long-term liability will be termed as. How are you financing your business? How are you arranging money for your business? 2 ways only you can arrange money for your business. One is your own money, equity. Otherwise, either through debenture or from bank loan. So, it's a change in your capital structure. It's not capital structure. Your total capital is made out of different sources. One source is equity, preference, debentures, bank loan, retained earnings. My company is in the business for many years. I don't want to distribute the dividend to the shareholder. I retain the profit to the business itself for a longer period of time to reinvest my business. Okay, to complete your business. So in this way, you can get money for your business. If any change in your capital structure, that is called financing activity. Changes in the size and the composition of owners' capital and borrowings. Now my business has 1 crore as total capital. Out of 1 crore, 60 lakhs I contributed, 40 lakhs I taken from bank as a loan. Now 60-40 is the debt equity ratio. If I borrow further 20 lakhs, it will become total is 120 lakhs. Okay, 6 lakhs my own money, 6 lakhs is from 40 plus 20. So change. If I repay also change. So this is called financing activity. Can you tell the example for financing activity now? Inflow of financing activity. Inflow. Further capital introduced by owner. Loan taken from a bank. Issuing debenture. These are the example for cash inflow of financing activity. Can you say cash outflow of financing activity? Retirement of loan, repayment of loan. Somebody told from online, repayment of loan. That's an example for cash outflow. There is no doubt. But what cash outflow it is? It's because of financing. You are repaying your loan. Payment of interest. That's an example for financing activity outflow. Payment of dividend. Example of financing activity outflow.
So buyback shares will come on.
Sorry?
Buyback of shares.
Buyback of share is a cash inflow or outflow. How are you buying back? We're paying cash. When is the outflow of
Yes.
at the same time your liability also
It is.
reduces. So it is nullifying the effect. You are paying your cash and you are retaining your own liability. It's nullifying the effect. So it's not a neither cash inflow nor outflow. One inflow is there, at the same time outflow is affecting. We discuss about that questions. Yeah. Next, investing activity. After collecting money for doing your operating activities, you have to do some arrangement. You have to have some kind of setup. We cannot just do business on the air, on the vacuum. We need some setup to be built up. Building we need, equipments we may need. Okay, we need some other furnitures, all those things. So to buy and sell, if you use any money, that is called investing activity. Investing. You are not investing outside your business. You are collecting money from the owner. Owner's money in the business is called equity. That is in the cash form. Now the cash form is going to be different form. I am paying cash to render of the machine. I am buying the machine. The cash has become machine. I have invested in machine. Of course, I invested in my business. The business in turn is investing in machine. So that purchase of fixed asset is an example for outflow of investing activity. Purchase of machine for cash is an example for outflow of investing activity. Can you tell me one more example of outflow of investing activity? Expanding business. Expanding business itself is an example for cash outflow of investing activity. Okay. Major repair work contribution. Payment of cash for major repair work. Installing additional capacity. Installing additional capacity in the machine is an example for investing activity. Buying some software. Buying software for your company. It's an example for investing activity. Outflow of investing activity. Can you tell some example of inflow of investing activity? Inflow. Return on investment is very, very common term. Don't use that here. Here you understand, something should come in cash to you. You have to say very specific. I'm going to college. Fine. But which college or what? I'm going to the college to see my friend who is studying there in college. I'm going to a college where I'm studying my MBA. Common. Specific. Be specific.
Dividend.
Payment of dividend is an example for finance. Interest received is an example for cash inflow of investing activity. What we are talking about? Cash outflow of investing activity. Anybody? Insurance. Very simple. You are thinking too much. Buying insurance is an example for outflow of operating activity. Cash outflow. You are paying money to the insurance company and you are getting a document, policy document. Why you are getting that? It's a regular routine activity. To insure your stock, your car, or your building. It's operating activity. Paying of interest is an example for outflow of. So what is the example for inflow of investing activity?
Buying asset.
Buying asset means you will pay money, you'll get money.
I'll pay money, but I'll get the asset.
Money. Pay or receive.
Pay.
What we're talking about?
Inflow.
So buying machine is outflow of investing. But I'm asking about an example for inflow of investment. Same thing. Market up, you have to reverse it. That's it. Selling. That's it. No. In which share? You are more into share market. Increasing revenue. That's a subjective term, right? Increasing revenue. What are you getting? Cash. Through what? Selling of goods. Example for sale of goods. How much you are getting? No matter. So last year I got 5 lakhs. This year I got 40 lakhs. Increase in revenue. Let it be. But for me, what is the matter? Is inflow or outflow? If it inflow, from what? If it is outflow, two way. If it is from sales, sale of goods, operating activity, inflow. If it is purchase of raw material for cash. Outflow. First you decide it's outflow or inflow. It's simple logic. Receipt means inflow. Payment means out. No accounts required. It's common sense. Then for accounts we have 3. What is the 3? Based on the nature of activity, we are dividing into 3. If it is about increase and decrease in fixed asset means increase or decrease in fixed asset means investing activity. Increase or decrease in long-term liability means financing. Regular day-to-day activity means operating. Profit? That is not cash at all. Profit, right? I'm telling you, this year my company has a profit of 3 crore. Where is 3 crore? 3 crore may be in different form. What you made profit in? From where you made sales? Sale of goods is an example for operating on cash. Collection from customer is an example for inflow of operating activity.
Sale of any building or land you had.
Yeah.
Like now you don't want to use it. That will be inflow for investing.
Purchase of machineries outflow. Sale of machineries of investing. Anything else? Doubt on this? Okay, now we are clear about what are the operating activities, what are the investing activities, what are those called as financing activities. Look at the definition. Those activities which are having principal revenue generating to a business is called principal revenue generating. Majorly the revenues are generated from that kind of day-to-day activity. If that is the case, that's called operating activity. For the Dhanasala University, fees collected from students is an example for
Operating inflow. Principal revenue.
inflow operating. Letting out the playground of Dhanasala University and getting rent for a tournament is an example for
Investing.
cash inflow from
Investment.
investment. That's not the business of
Sign.
helping the society to have sports promoted. Sports promoted. Okay. Those are not having the facility, they can use it. Similarly, interest earned from bank deposit. Interest earned from a bank deposit is an example for inflow from. So, for whom it is, that decides what activity it is. For a furniture manufacturing company, if you buy a machine, the machine is the money paid on purchase of machinery is an example for Outflow on investing activity. Suppose there is a machine vendor. Their business is vending machine, buying machines, showcasing it, vending it, selling it. They are buying a machine by paying cash. Now, for the machine vendor, purchase of machine for cash is an example for outflow of operating activity. Okay. The definitions are there, you can read it later. Okay, now, according to accounting standard, we have this cash flow statement to be prepared in indirect method. What is indirect method and direct method? There are two methods in which you can prepare it. But accounting standard AS3, accounting standard 3, recommends us to prepare the cash flow statement by following the indirect method. So what is direct method, indirect method? Wherever you have each transaction, if you prepare, it's not direct method. Whenever you receive money, you follow a cash flow statement, means direct method. But it is very difficult. We don't analyze before we prepare anything. That's not a logic also. We just prepare something, let it go on its flow. Finally, you analyze what has happened. If I do a test every day, every now and then, after telling one statement, I understood, write this quiz. If I do like that, it will be confusing. I have to give you some space to read, understand. Then I have to test you whether you understood or not. Similarly, analyzing will happen only after something is made and something is done. Then I can analyze whether this happened right or not, what's the problem. I can do it. I can correct myself in the next period, next tenure, I can correct it. So if you do not do that, if you do simultaneously preparation of cash flow as well as cash account, means we call it direct method. Indirect method means let the accountant complete his accounting process. Let him prepare cash flow, cash account, let him prepare cash book, let him prepare trial balance, let him prepare payable account and balance sheet, let him complete the accounting cycle. After that, as an analyst, I will take the data from him in the income statement as well as from the balance sheet, as well as some information I collect from him, and I will prepare a statement called cash flow statement. If I do that, the method is called as indirect method. Okay, indirect. Yeah, this is a pro forma of cash flow from operating activities. Actually, what you are going to do is you are going to start with opening balance plus or minus net operating cash inflow plus or minus net investing cash inflow plus or minus net financing cash inflow. Three cash inflows net. Operating may be having plus 10,000 minus 2,000. Net effect is cash inflow of 8,000. Similarly, in investing activity also, there may be 10 activities, 4 may be inflow, 6 may be outflow. The net result I have to find. Okay, so opening balance of cash and cash equivalents plus or minus net cash inflow or outflow from operating plus net cash inflow or outflow from investing plus net inflow or outflow from financing. Okay, 4 figures I have. Opening and these three put together. See, depending upon the symbol. Inflow means plus will be there, outflow means minus will be there. Depending upon the symbol, I will take one more figure. Suppose 10,000 minus 2 plus 5 plus 8. All these added together, based on the symbol, I'll take one value. That value is called as cash and the cash equivalents at the end of the period. That should be equal to what is there in the balance sheet of the company. So that's what I'm going to prepare now. Only here this pro forma is given for how to get the cash inflow from operating activities. Remaining all we can easily understand. Investing and financing you can easily understand from the balance sheet. Suppose last year balance sheet is showing you capital of 1 lakh. Current year balance sheet is showing you capital of 1.5 lakhs. What's the meaning? Additionally, capital was introduced. So it's an example for inflow of financing. Suppose last year bank loan was 10 lakh. How do I know in the balance sheet? Last year balance sheet. Current year balance sheet Bank loan is 15 lakhs. So
You've taken 5 lakh.
additionally, loan you've taken. So it's an example for cash inflow from financing activity. So you have to go there and write it. Cash inflow from financing activity loan 5 lakhs. Like that you have to write one by one. Okay. But in the profit and loss account, we don't have like this. Because it's for the period. It's not for 2 periods. It is for the entire period. So what you have to do is, net profit is the starting point to find out the cash flow from operating activity. Net profit is not just the profit of operating activity. Please understand. In the income statement, we write dividend received, interest paid, depreciation, many things you write. You remember the income statement? Revenue from operation or sales plus other income plus total income minus expenses. From consumed, changing stock, employee benefit expenses, finance cost, other expenses, depreciation and amortization. The following is there. So all expenses are debit to payroll account to find out the net profit. But this is talking about only operating activities, profit or loss, inflow or outflow. Dividend you are paying, interest you are paying, all those things may be minus from profit, but it is not really operating expense. Interest is not operating expense. So what you do is you take net profit as per the P&L account as a starting point, plus all non-operating expenses you have to add. Why? If you're adding non-operating expenses, you're finding out the real operating profit. You understand? Net profit of the business is 10,000. But the company has paid interest of 2,000 rupees to the bank. If the interest is not paid, what should be the profit of the company? 10,000. What's the net profit now? 10,000. This company has already paid 2,000 rupees as interest. If it is not paid as interest, how much should be the profit of the company? 12,000. Really, profit is 12,000. But you minus 2,000 rupees because of interest you paid. Interest is not a operating expenses. So I'm telling you, you have to add some non-operating expenses which were already there in the P&L account. If it is there, you have to add it back to find out the real operating profit. Then there are some non-operating income. Dividend received is there. Interest received is there. After adding these two, your profit is 10,000. Now what do you do? You minus net profit as per the P&L account starting point plus non-operating expenses if everything is there in the year minus non-operating income. Non-operating income. Why income you are connecting minus, sir? Already income is added, but that is not an operating income. Letting out my ground and getting in rent for the ground is not my operating income. But I already shown in the P&L account. I am minusing. Clear? Similarly, any non-cash expenditure, if it is minus from P&L account, what is non-cash? Depreciation, amortization, writing of any goodwill, writing of any P&L expenses, writing of any other expenditure, writing off. You did not pay anything, but you shown as an expense. That has reduced your profit. Really, it is not operating. Really, it is not a cash expenditure. Maybe operating expenditure. It may be operating expenditure, but it is not a cash expenditure. There's no flow. Simply you wrote in the books that you have to remove now. How do you remove it? Adding all those non-cash expenditure. So simple. Net profit as per P&L account. Look at this. Net profit as per P&L account for the current year. Which year you are preparing cash flow statement for that year? Where you can get this amount? P&L account. Okay. Plus non-cash and non-operating expense. Depreciation is a non-cash expenditure. It's operating expenditure, but it is not cash expenditure. That's right. Depreciation, loss on sale of assets, provision for taxation. Similarly, non-operating income. I told you profit on sale of assets or interest. I told you interest on deposit. Okay, anything like that. You have to add and you have to minus. Net result is net profit after adjusting for non-cash items. From that, you have to minus non-cash items. Non-cash item means current asset and current liabilities. Increase in current assets is an example for when your current asset will increase.
There is an inflow, right?
Simple. So increase when there is an inflow. Cash inflow. When your current asset will reduce, when there is a cash outflow. Suppose 1,000 rupees you are paying for bank deposit, bank 1,000 rupees. There is no increase, there is no decrease. 1,000 in the form of cash has become bank. Both are current assets. In this case, there is no change. Suppose you are taking 1,000 rupees and settling your loan. You are paying your creditors 1,000 rupees. Now, current asset 1,000 reduces, cash 1,000 reduces, and then 1,000 rupees worth of creditor is also reduces. Okay, in that case, if it is increase in current asset, you have to minus from the previous value. Okay, if it is in decrease in current assets, you have to plus. What is decrease and increase? Comparing 2 years figure. Current year stock 2,000. Last year closing balance of stock is 3,000. Increase or decrease? Decrease. From 3 it has come 2. So 1,000 is difference, that is decrease. Decrease in current asset, you have to add it. Okay, next. Increase in current liability and decrease in current liability. Just you remember one means remaining 3 you can easily remember. Increase in current asset to be minus. If that is the case, decrease in current liability should be opposite. No, look at this. Increase in current assets. Increase in current liability. These two are opposite. Asset is liability, opposite. Okay. Similarly, current asset decrease, decrease in current liability. So you have to remember this plus minus when you are doing cash flow statement. Only for finding out the profit as per operating activity. Remaining all you can just take from the balance sheet. Increase, decrease, increase, decrease, you can take it. Okay. Look at this example, you'll understand. So this is a balance sheet, correct? Shareholders capital 5 lakh is there. There is no change. If there is no change means what? There is no inflow or outflow from that particular item. Next one, reserves and surplus. Look at reserves and surplus. 50,000 was the reserve, but now it is. So 40,000 rupees we made reserve in this current year. How that reserve has been made, you have to check. Look at this. This 90,000 was the closing balance as per the P&L account. 50,000 opening balance as per the P&L account. Look at the P&L account here. Here it is given. In the note number 2, you see note number 2. Yeah, note number 2, 50,000 is a P&L account. Okay, that 50,000. Okay, plus goodwill amortization. What is goodwill amortization? Look at the balance sheet of goodwill. Goodwill. Asset side, you look at the goodwill. Tangible. Sorry, sir, where it is? Yeah, goodwill is 2,05,000 was there. Now it is 1,80,000. How much was depreciated? 25 was depreciated, means this 25 was taken from profit of the current year. So you have to add it back. 25,000, you have to add it back to find out the real operating profit. Plus interest on debenture. Interest on debenture is an expense, outflow, but it is not an outflow of operating activity. So you have to add it back. Look at this. Debenture is 5 lakhs. Interest is 10%. So amount will be, no, 5 lakh is the last year balance. Current year balance is 7,50,000. Is it so? 7,50,000? Yeah. Percentage is 10%. So 75,000 is the interest. So net cash from operating activity is 1,40,000. Simple logic. Opening balance of profit and loss account plus or minus operating, non-operating expenditure and income plus or minus non-cash expenditure and income. Okay. If you do one more question, you'll understand better. Bigger question I'll show you. Yeah, look at this one. This is a very big question. No problem. We'll take one more question. Small question. Yeah, look at this question. 7th question. Balance sheet is given to us. Notes to accounts. The explanation for the amount in the balance sheet is given to us. P&L account is there. Now you have to put some more information is also given, additional information. From this, you have to prepare a cash flow statement according to AS3. Okay. Now this is the format. Particulars, amount, cash flow statement of so-and-so company for so-and-so year. Okay. Cash flows from operating activities. Net profit before tax. It is given there in the where you can take this amount. Profit and loss account 4,500. Look at this 4,500. Okay. If you take after tax, you have to add back the tax. Sometimes it is not explicitly given, means you have to take it as it is. You have to add back the tax. Okay. Profit before tax. Then tax expenses. Current year, how much it is there? Yeah. Adjustment for all these things. Non-current, non-operating as well as non-cash. Depreciation is always a non-cash expenditure, so you have to add it back definitely. How much depreciation? 3,500 added back. Profit on sale of vehicle. Look at this vehicle. There was one vehicle sold. Vehicle. How much was vehicle so far? Vehicle, where it is? Yeah, vehicle. 12,500 was the opening balance. Closing balance is? No. 8,000 was opening balance, I think, right?
Yeah.
2020 is 8,000. Yeah, 12,500 is the closing balance. In between, is there any change, purchase or sale? Where it is? Note number? Yeah. Yeah. Yeah, vehicles. There is a vehicle was sold for 1,800 and 1,700. Is there any vehicle purchased in between? Okay, and depreciation also there in the vehicle, 2,500. Original value of vehicle is how much? Opening balance of vehicle is 8,000. Okay, depreciation is how much? 2,500. Sales is 1,700. So is it a profit or loss? How it is calculated? Profit or loss? 1,700 or 1,700 is the sale value. Correct? Am I right or not? 1,700 is the sale value. How do I know it is given here? Proceeds from sale of vehicle, 1,700. But what is the value of the 1,700 when you sold? Depreciation on this return down value. Look at this. Return down value of depreciation on this 1,700. The depreciation so far computed is 1,000. Book value is 1,700. Now depreciation 1,000. No. Yeah. So what is the cost of machine right now? 700. For how much you're selling? For how much you're selling? No, 1,700 sale value. 1,700 sale value. Okay. Return down value of machine is 1,000. Return down value of the machine itself is 1,000, not depreciation value. Machine itself is 1,000. Vehicle is 1,000 rupees, but it is sold for 1,700. What is the profit on that? 700 was the profit. It was already added in the profit. Now we have to minus to find out the real operating profit. Okay, likewise, you have to check one by one. Next one is, so 4,500 plus 3,500 minus 700 is equal to 7,300 is the operating profit before working capital changes. What is this before working capital changes? Current asset, current liability. Working capital changes. Now, look at the balance sheet, asset side, current asset side, balance sheet, current asset, yeah, current asset side. We have investment, current investments, how much?
Increase in 1,000.
Increase in 1,000. So what should you do? You add or minus? Increase in investment is there or not? Yeah, current investment 1, 2, 3, 4. Yeah, 2,000 to 1,000 to 2,000. 1,000 to 2,000 increase in 1,000. Next inventory increase. Trade receivable increase. Cash and cash equivalent you should not take. Why? That is the opening balance. In the look at the cash flow statement. Look at this. Cash and cash equivalents at the beginning of the period. You can take it here or you can take the first one. You can take the first line also. You can take here also. Here also you can take, before starting this, you can take this opening balance of cash and cash equivalents. Otherwise, you can bring it here. Both will do the same logic. A plus B plus C plus D. Otherwise, D plus A plus B plus C. All are same. Okay. So now look at the change in current assets. Change in current assets one by one. Change in current asset. Investment, inventory, trade receivables. Three things. Look at the cash flow statement. Increase in receivables, inventories, and then trade payables. Investment, yeah, purchase of current investment 1,000 rupees is there. There is a change of investment, but investment is not just taken here as a current asset. Why? Investment, current investment is what? Outflow only, but what does that mean? It's cash and cash equivalent. That's why taken separately. Okay, now inventory 3,000 rupees. Look at this. Inventory 3,000. 3,000. It is increase. Increase in inventory means increase in stock. Increase in current asset. According to the format, increase in current assets should be minus. So minus. Okay. Similarly, look at this increase in trade receivable 2,000 rupees minus. Increase in trade payable. Trade payable is current liability. So increase in current liability should be added back. We're adding it. If you do all these things, you will get 3,800. Okay, that's called cash really generated from operating activities. I repeat again, net profit plus or minus or do adjustment for non-operating expenditure and income and also for non-cash income and expenditure. After that, you have to adjust for increase or decrease in current liabilities and current assets or change in working capital. Okay. After that, you have to minus tax. What's the tax here? Income tax paid is 1,000 rupees. So net cash generated from operating activities only 2,800. Similarly, you go to cash flow from investing activity. How do I find out investing activity cash flow? Balance sheet. Which side? Asset side. Investment is asset, non-current asset. Go to balance sheet. Non-current asset. Yeah, non-current asset. Property. Note number 4 is there. Go to note number 4. Yeah. Building was 10, now also 10. 11 was picture, now it is 17. Vehicle was 8, now it is 12,500. So there is a change. Okay. So increase in non-current asset is example for outflow of investing. Decrease in non-current asset. Decrease in fixed asset is example for inflow. So accordingly, I would write it here. So go to the statement and see. Sale of vehicle, inflow, 1,700. Purchase of vehicle, outflow, minus 800. Purchase of investment, we are buying investments, 1,000 rupees worth, outflow, so minus. Then purchase of furniture, 7,000 rupees. Net, look at this, all put together net. 1 plus 8 plus 7, 16 minus 1,700 is equal to 14,300 minus. What is this called? 14,300. Net cash used in the business. It's lost, used in the business or outflow. Okay. Next, cash flow from financing activity. How do you know financing activity change? Balance sheet, liabilities. Balance sheet, liabilities. I'll go to balance sheet, liability side and check it. Yeah. Non-current liability, not current liability. Current liability already we discussed in the working capital changes. Okay. Now non-current. Share capital plus reserves and surplus. Reserves and surplus already discussed. Only share capital is there. 50 to 60. There's an increase of 10,000. It is inflow or outflow? Inflow. 10,000 is inflow. Money is increased because of the inflow. We have issued further capital. We have taken some money from shareholders. So issue of share capital, 10,000 rupees. And there is a dividend paid. Dividends. Look at this. Dividend paid. Dividend paid is an example for what? Outflow of financing. Dividend received is inflow of investing. Dividend paid is outflow financing. Okay, so we're writing it outflow financing here, 3,000 rupees. So net cash flow from financing activity is 7,000 inflow. So now you take the opening balance of cash. Opening balance. What is opening balance? 8,500. 8,500. All these three items, add or minus, depending upon the symbol. Then you get the closing balance. Closing balance is how much? 4,000 rupees. How it is 4,000? This 4,500 minus 8,500 is equal to plus 4,000. Okay. How do I know this is the same amount? Look at the balance sheet. Cash and cash equivalent. How much is the current year? 4,000. It should come match. Okay. Now we found out what is the how the difference is. How the opening balance was changed to 4,000 in these ways. Now from this you can understand which activity has resulted in more cash inflows, which activity has resulted in more cash outflows or inflows. Okay. If you have more inflows in operating activities, more money comes from operating. We earn money through operations. So more money comes from investing activity. Actually, investment activity should not be more money coming in. Go out. You should have invested so much of money in the land, building, equipment, etc. That's good for the company for growth. But there is a cash inflow from cash investment activities. What's the signal there? You are receiving more money from cash investment activity. That is the meaning of disinvesting everything. So more money comes from investment activity means what does it imply? You are selling more fixed asset and getting more money. That is not good for. Provided if there is no replacement. Every investment you have to disinvest and you reinvest. That's what it is. So any decision you are taking before you write any interpretation, you would think in different perspective. You cannot go and tell some conclusion simply on one number. That will be slide, even for Asia and not saying. Okay. So this is a simple cash flow statement. Any doubt on this? It will little what you can say, need some practice. It cannot be just understood. You have to practice this. But logic is net profit plus non-operating expenditure minus non-operating income plus non-cash expenditure minus non-cash income is equal to cash generated from operating activities before tax minus tax. Okay. Before that, if there is any change in working capital, you have to adjust that answer. Change in current asset, change in current liabilities. Then you take the next point number B, investment activity, point number C, financial activity, all ABC together plus opening balance should be equal to closing now. Thank you so much. Read this again and practice 2-3 questions on this. See you. Thank you. Those are online, in doubt before we wind up the session?
Sir, Shahrukh here from online site.
Yeah, sir.
This assignment, sir, is it a individual activity or the group
It's
activity?
individual activity, individual assignment.
And the deadline is, I mean, final deadline, or it can be extended in case.
Final deadline.
Okay.
Already we have given a lot of time, no?
Yeah. Sure, sir.
Yeah. Awesome. Any other doubts? Any other doubt online, people?
Yeah. And sir, when will we get to know the score of our first assignment?
In a couple of days.
Okay. Yeah, sure. Thank you, sir.
Thank you so much. See you again. Be in touch in WhatsApp group. Ask so many questions, whatever you have. Don't wait for the next class.
Thank you, sir.
Sure, sir.
Thank you, sir.
Sir.